If you believe, as I believe, that in this sense past its prologue, that the US dollar will lose 75% of its purchasing power over the next 10 years, like it did back in the 1970s, and I believe that, I think it's reasonable to suppose that the nominal price of gold, when I say nominal, I mean US dollar price of gold, will increase in a way that mirrors that.
I think the problem with America, the currency is the reserve currency. If the foreigners take fright and say, we're getting out of the dollar, you're looking at ownership of the dollar, which exceeds US GDP by fully 1/3. That could be a real problem.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for September 29th through October 6th, 2025, while supplies last. First this week, 1 ounce gold Philharmonics are just $75 over spot. Next, 90% silver US half dollars are just 69 cents over spot per ounce. And finally, the silver Australian Year of the Snake coin for 2025 is just $5.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. I'm your host, the founder of Liberty and Finance, Dunagan Kaiser. I'm here with a panel of experts on investing and asset management. We've put together a very special summary together with picking the brains of these experts on the risks that are currently being faced by asset managers and treasurers, whether it be on a small scale, such as homeowner associations, hospitals, churches, schools, that sort of thing, or large insurance company, asset managers, and others managing large pension plans on the behalf of many moms and pops. We've got Alasdair Macleod, we have Rick Rule, and we have Andy Schechtman, who will be joining us shortly. I'd like to introduce each of our guests on this all-star panel one at a time. First of all, starting with Rick Rule. Most of you know Rick well. He's a regular guest on our channel and was invited for this special asset management overview because in addition to steering global resource investments for 19 years, now known as Sprott Global Resource Investments, and Sprott US Holdings, Inc. as the CEO for 10 years. And by the way, Sprott today serves over 250,000 global clients and has $33.4 billion in assets under management. Rick Rule is also a renowned investor, a prolific investment educator, and as an expert credit and risk analyst for corporations through market changes. Mr. Rule has structured, led, and participated in hundreds of privately placed debt and equity issuances for resource companies operating internationally. Rick Rule is a sought-after investment conference organizer and speaker as well, having hosted and presented at hundreds of resource and investment conferences over the last 30 years, and now the CEO of Rule Investment Media, including the Rule Classroom and the annual flagship symposium, the Rule Symposium on Natural Resources Investing. Rick, thank you for coming back on Liberty and Finance.
Pleasure, Dunagan. Thank you.
We also have Alasdair Macleod with us. Alasdair's been in the securities industry since 1970s as a stockbroker, investment manager, executive bank director, and additional fields of expertise include corporate finance, research, and economic analysis. For the last 15 years, he was head of research for Gold Money, Inc., writing weekly reports on market economics and geopolitics. He now concentrates on his Substack newsletter at Macleod Finance to inform and educate as wide an audience as possible about the economic consequences of past and current monetary policies. Alasdair, thank you also for joining us again on Liberty and Finance.
That's my pleasure, Dunagan.
We'll be joined shortly by Andy Schechtman, the CEO of Miles Franklin Precious Metals, and I will give you his intro when he arrives. First of all, I wanted to set the stage here with our guests. Why are we doing this? Why are we gathering a group of panelists who are experts on asset management to talk about the current challenges being faced by asset managers around the country who are in positions of responsibility, shepherding the funds, endowments, nest eggs, treasuries of organizations on behalf of ordinary moms and pops or students and patients and residents and so on of their organizations. The reason is that Liberty in Finance has been trying to bring on guests for over 13 years to educate people, ordinary household owners and across the country, about the risks that they're facing to their financial future and well-being. And yet we realize that we're speaking to individuals, but many of those are depending on and relying on pension plans, retirement plans, certificates of deposit, and insurance backing of pensions, et cetera, to take care of them going forward and to look over their assets. And yet we realize that the traditional methods that are being used for risk mitigation by many asset managers may be better suited to the past 40 years than to the next 10 years in changing times. And we have a quote here I wanted to kick off with, surprising source. It's from Scripture, Luke 14, and it says, "For which of you intending to build a tower does not sit down first and count the cost, whether he has enough to finish it, lest after he has laid the foundation and is not able to finish, all who see it begin to mock him, saying, this man began to build and was not able to finish? Or what king going to make war against another king does not sit down first and consider whether he is able with 10,000 to meet him who comes against him with 20,000? In this metaphor of building a tower or waging war against an opponent, we are looking at those who are shepherding the finances on the behalf of ordinary moms and pops and the battles that they are facing. Two letters that came across my desk just in the past recent time. One is from a very, very poor school in India, where the charity is reaching out and saying that they started to build, but that the price of steel, they built the first 2 stories of the school, and then the price of steel went up due to inflation, and now they can't afford the rebar and the reinforcements to finish the school, and they're going back for a second round of appeals to their donors to see if they can continue finishing the school. The most recent was just from a week ago, from one of the most affluent and well-known parishes in the United States, saying that they have a major capital building project to expand their church buildings, and it was going to cost $10 million, and now $21 million. Just a few years later, they said they can't even keep up with additional rounds of donations to even get enough of a pile of cash to start the project, because the prices keep going up faster than they can save. And so at that level, both a small and large, as well as we'll bring out some other stories that just came out in the past couple of weeks about official announcements of nationwide major endorsements for real assets as a way of hedging against risk in inflationary times. So I guess I'd like to first turn to Rick, if we could, and feel free, guys, just to jump in wherever it's natural in the conversation, but to talk to us briefly, if you would, about the changed landscape for asset managers and those who are guarding treasuries against risk and volatility. If they're using the methods that have worked well for the past 40 years, say, what has changed that makes those methods that they've been accustomed to perhaps not suitable for the next decade?
Big question. I'll do my best to give a brief response. I believe the period 1982 to 2022 was perhaps the most benign economic climate in human history. The baby boomers were coming of age. They had that wonderful demographic boom, great labor force participation around the world, increasing amounts of free trade. Wonderful, wonderful, wonderful time. Falling real interest rates, US dollar hegemony, so financial stability. I think about 2022, that epoch came to an end. And I think people are continuing to invest as though that set of circumstances were true. That's really the challenge. I don't think that you're going to see falling long-term real interest rates again for a long time, despite governments' attempts to manipulate them. I don't think that you're going to have the demographic advantage that you had with the baby boomers, although I do think that rising emerging and frontier markets economies will help temper that. But I also who think that you're going to have falling real yields. And by that, I mean that the yields offered up around the world on savings products are likely insufficient to cover the deterioration in purchasing power from various currencies. Most importantly, of course, being the US dollar. I say most importantly, not merely because I'm American, but because the U.S. economy generates 23% of the world's savings and investments. It is, for better or for worse, still the world's reserve currency. If you believe the CPI, the government statistic, I refer to it as the CPI, you believe that the deterioration of the U.S. dollar is proceeding along at about 2.9% a year compounded. Not good, but not bad. If you look at the basket of goods and services that real people consume, including prominently tax, the CPI doesn't include tax, which makes it a silly measure of the cost of living. I believe that the deterioration of the U.S. dollar's going along at about 8% a year. So you can see the problem arithmetically. If you're saving at 4.5% and you're spending in a currency that's depreciating at 8%, buying what is allegedly the safest savings instrument in the world, the U.S. 10-year Treasury, guarantees you a 3.5% compound loss. And that's the real challenge facing asset managers. The old long bond portfolio for university endowments and insurance funds guarantees that you won't have enough money to satisfy your obligations 20 or 30 years out. Fairly stark reality.
And Alasdair, if you could, you've been on also, both of you have been on a mission to educate as many people as possible. I know, Rick, that's your mantra, is invest in your financial education. And that's the thing that delights you the most, is to see people who are taking responsibility for that. Alasdair, you've been speaking with industry, but also government groups at high levels, talking about the plight that they face trying to prepare for the changed economic environment that we're in, and perhaps some adjustments to their approach. Any further thoughts from you on what Rick was just expounding on the changed environment that may not be suitable to use the same bag of tricks or the same weapons of war that worked for the past 4 decades?
Broadly, I think what Rick says is absolutely right. I mean, anyone looking at a pension fund is actually on a loss, or a loser. The only thing you can really do now is protect yourself against the declining purchasing power of currencies. And the only way in which you can do that is to buy physical gold. I mean, I would prefer ownership of gold rather than indirect credit through an ETF. And the other thing, I think, is to look at maybe some other commodities, because the one thing that's happening, which we just don't understand in the West, is that there's a whole world out there being run by, dare I say, China and Russia, are small enemies, but they basically are assembling the majority of the world's population, and they're going to industrialize it. And that's going to require an awful lot of base metals. It's going to require also gold and silver for monetary purposes. And so that's the area where you've got to look. And we haven't had any sort of move out of conventional investments into these defensive sectors. And that, I think, is going to be an interesting challenge, particularly when you understand that equity markets are basically being sustained by a credit bubble. I mean, just look at what's been going on with the leverage, if you like, the debt leverage through loans, to investors who have been leveraging up in order to improve their returns on, presumably on the Magnificent Seven or whatever. They're so greedy. I mean, the latest figures from FINRA looks, I mean, you're looking at over $1 trillion outstanding there. Now, that's got to be unwound. And it will, I mean, it's a sign, if you like. It's a clear sign that this is a credit bubble. And if you look at the behavior of investors, I mean, they're just chasing momentum. Who gives a damn about value? That's not the way to go. So it reminds me so much of the dot-com bubble back in 2000. So all the symptoms are there, the psychology and everything else. And then on top of that, we've got President Trump's beautiful tariffs. And I tell you, this just reminds me of 1929 when we had, the roaring 20s, which was the puffing up of credit, the credit bubble. And then you had the collapse from a high point, I think in September 29. Market lost 90%. And guess what? We had tariffs as well, Smoot-Hawley Tariff Act. That came in. The whole situation is so reminiscent of that. But this is far larger. This is a dangerous time. But at some stage, investment managers are going to realize they're doing completely the wrong thing. And I think it's just beginning. For example, you see major banks like Goldman Sachs, Bank of America, Citicorp, whatever, now saying gold's going to go 4,000 or 4,300, whatever they say. But think about their poor clients. They haven't got any. I've been knocking on the door and saying, look, your analyst is saying gold's going to 4,300. What have I got? You've just got me the wrong bloody stuff. And this will be acute when that credit bubble pops. Because I tell you what, it's going to be a very nasty scene in industrial equities, in stocks and all the rest of it. And I don't know how much people will be able to get out. But at the moment, on average, if you look across the roughly 300 trillion of investable assets, less than 0.5% of that is in gold. They've got it completely wrong-footed. So I really think that the next few months, and I think it's that soon, the next few months are going to be extremely interesting from the point of view of the switch, if you like, away from, the current winners, which will become suddenly, like cyanide to investors, into obviously what's already running, and they just haven't bought it. So it fascinates me that, look, I'm a fairly simple soul. I just say, get the hell out of credit, just get into gold or silver. Rick actually is more at the coalface, analyzing companies and all the rest of it. So that's probably where the leverage is on this extraordinary story at this moment in time.
You both mentioned retirees, and I wanted to read a couple of statistics to place this in context regarding, quote, working longer or unretiring for any reason. I had never even heard the word unretiring before. 20% of retirees are now working or return to work, according to the AARP and Investopedia. And in addition to that, a survey by Resume Builder found an additional 1 in 8 retirees said they're likely to go back to work in the coming year, and giving cost of living pressures as the top driver of that. And I can attest from the fact that we live in a 55 plus community that we have neighbors who said that they were retired. Their personal financial advisors said they're on a glide path. They have to make no adjustments as recently as 1 to 2 years ago. And now they're being told by their same personal financial advisors that if they don't cut expenses or get a job, get some form of income started up, or both, they won't be able to continue on. And one had to move out and go to a less expensive living area just in order to try to cut taxes, cut expenses. So any comments from either of you about the plight of retirees who thought and believed and were told and were guided into their current path, that they're now being told, actually, no, things have changed. You got to get back to work, or you got to cut expenses. You got to change something up if you're going to remain retired.
Well, first of all, fire their advisor. Personal financial planning over time is a very long-term endeavor, but the arithmetic around it is fairly simple. The second thing is that talking to either Alasdair or myself about retirement is fairly foolhardy. Both of us have failed completely. It's important to note that when Social Security was instituted in the United States, its mandate was to provide basically poverty-style existence for people above the age 65. And the median life expectancy of an American male when Social Security was instituted was 66 years. Demographics has changed. And so it makes perfect sense that people would need to prepare to live longer. I don't recommend retirement myself. I enjoy working. Let's just say that my mind needs to be either stimulated or sedated. Working for me is much healthier than drinking. And the consequence of that is that I like to work. On a more serious note, I think that if you look at the solvency of various retirement systems, including Social Security, that you come to the conclusion that you need to take care of your own retirement. If you are American, you need to bear in mind that according to the Congressional Budget Office, the net present value of unfunded entitlement obligations in the United States exceeds now $120 trillion. This number doesn't come from a balding, fat, cranky old libertarian. It comes from the Congressional Budget Office. Now, to put that in perspective, gross federal income is $5 trillion a year. What do you think the probability is that the United States, and Alasdair will have to give the European or British numbers, but what do you think the probability is that the U.S. government, with $5 trillion in gross income, and of course a government and a nation to run, can honor $37 trillion in on-balance sheet liabilities and $120 trillion in off-balance sheet liabilities? Think about the arithmetic around this, and think about despite the fact that you paid into Social Security for 40 years, which is irrelevant, there isn't enough money to take out. Think too about some other form of retirement entity, perhaps private, that invested the bulk of their proceeds in 20 or 30 year debt obligations, yielding some number like 4, 4.5, or 5, where the underlying inflation rate is 8. The managers are in for a tough spell. If they sell those low-yielding instruments, they take hits to principal down. If they hold them, they guarantee the fact that they can't fund their obligations over time. Talk about a rock and a hard place. So understand where you are, understand who you are, and plan accordingly. It's your only chance.
There's some notes that I gleaned about what professional asset managers are in fact doing to diversify and to try to hedge against risk. It sounds like some of them are relying on things that worked well over the past 4 decades, and some are stepping out into new territory. We have bond portfolios, many long-duration bond portfolios still sitting on unrealized losses due to the rate shock of 22 and 23. Most asset managers rolling into shorter duration bonds and diversifying for currency and geographic risk, but some are increasing exposure to gold, non-sovereign debt, and even crypto hedges against US dollar weakness. Volatility expected to rise, and managers preparing for increased cash by increasing cash buffers, staying liquid, and emphasizing quality in equities and credit. So even well-diversified portfolios may be making some preparations but not fully protected, and says specifically it can lose value in a true polycrisis scenario with high inflation, slow growth, geopolitical stress, and falling US dollar confidence. Alasdair, you often and usually looking at things from a global standpoint. Any comments from you on these measures that are being taken by asset managers and how effective you see that they're likely to be?
Well, one thing you said in that little bit was that there's a bit more volatility and all the rest. I tell you, pension fund managers do not want volatility. They want certainty as much as possible. So volatility is not the way to go. It really isn't. And if they're going to be looking at things like Bitcoin and so on and so forth, I mean, that's the end of life as far as they're concerned. I mean, the situation that Rick described is exactly the same in Europe, but we've got other things on top which make it even worse. First of all, we've got something called defined benefit pension schemes. Now, these basically will pay a guaranteed 2/3 of salary, inflation-linked, etc., etc. But guess who's got them? Bureaucrats, civil servants. Nobody else has got them. So in other words, the cost of this is just escalating. And as to Rick's point about inflation, I mean, not only is it running at a far higher level than CPI statistics would have us believe, But on top of that, my forecasts are that we're going to get far higher inflation in the next 2 years. The reason I say that is if you look at what's happening, gold is signaling, if you like, it is anticipating a collapse in the purchasing power of fiat currencies. I reckon this is the end of the fiat currency era, which started in 1971. Now, under those circumstances, you're going to see prices rising, not because they're rising, they'll actually be falling in real terms, but because the currencies are falling even more rapidly. This is playing havoc with any pension fund manager's arithmetic. I mean, it really is. And then on top of that, of course, over the last, 50, 60 years, pension fund managers have been encouraged to diversify out of bonds and into equities. So when you get an equity market bubble going pop, this is going to again cause huge damage. And further on that, of course, was the sort of baby boomer population, which Rick and I are honourable members. We're all drawing pensions now, and the numbers have increased quite substantially. I mean, it's just everything in this arithmetic has just gone wrong, and you cannot rely on a pension to keep you in your old age. I mean, I know so many people who've been in government, for example. They got these lovely pensions. I reckon that at the end of the day, they're probably worth nothing. So, you're going to actually start thinking for yourself in this one and take some action to try and protect yourself. Sign up for account with Rick, or go and deposit some gold somewhere outside the banking system. That's obviously going to be the answer. The rest of it is just hot air. I mean, it's very dangerous.
Rick, any additions from you on that before we bring up a couple of news stories that underscore what Alasdair just said?
Yeah. And towards the end of the interview, we've got to give people some life. This is pretty gloomy. I've noticed a lot of use of the phrase diversification. And I think another problem is that we've enjoyed so much success as investors in the last 40 years that we've become hubris-ridden. Diversification is only good if you understand the sectors you're diversifying into. I am pretty undiversified. I understand conventional financial services, which is to say banking, insurance, asset management, investment management, and I understand natural resources. I'm asked all the time about crypto, and I say I don't do it because I don't understand it. I'm asked about technology. I'm not really sure how to pronounce NVIDIA. I think I got it right. But the idea that I could tell you if it was overvalued or undervalued, not understanding what it is they do for a living, the probability of that is nil. So I would caution people with regards to diversification. I would ask people to invest to the extent that they could in industries where they or their financial advisor understood them well. Perhaps it's because my own brain span is constrained, but the idea that a human, or even many amalgamations of humans in asset managers, could understand 100 industries or 200 industries has always seemed suspect to me. I would throw out one more caution. That is that today people seem to conflate the term liquidity with the term solvency. And I think that's one of our great conundrums, even in government. Our governments are quite liquid today, but I would argue that they're insolvent. To make this personal, let's say in the United States that you have a job that's paying you $60,000 or $65,000 a year and you have $30,000 in savings, but you have $1 million mortgage. You have $35,000 in your jeans. So if you want a case of beer, you can buy one. The problem is that you can't service a $1 million mortgage on $60,000 a year. You're liquid, but you're not solvent. And when I look at the pension structures existent around the world, and I look at the slavish reliance that people have on communal organizations called governments, and I look as a credit analyst, which at the bottom of my soul is what I am, I see a circumstance around the world where we have more than ample liquidity, There's lots and lots and lots of dry powder in the world. But on an actuarial basis, looking at 20, 25, or 30 years, we're insolvent. I mean, I know, I know how this ends. You reprice the debt securities, or more correctly, you devalue the denominator. You reduce the purchasing power of the currency that this insolvent instrument is held in, and you have a dishonest default. I understand how it ends. I watched it end that way in the decade of the 70s, by the way, Dunagan. Many people don't realize this, and I'm sorry to revert to US dollar terms always because I'm an American. I understand them. That same Congressional Budget Office that I cited earlier says that in the period 1970 to 1980, the purchasing power of the US dollar declined by 75%. That's the way we solved our last debt crisis. We devalued the real value of the payments. And I suspect that's how this one ends too. Not the end of the world. We survived the 70s. It was a character test. None of us needed it. Alasdair and I were both characters at the beginning of that epoch. We didn't need the test that we faced. But that's how it works, and people need to prepare for that.
Yeah, as to that point, I mean, I also remember, government bond yields in the 70s. The UK government bond yields soared to over 15%. I think the top it was about 16%. And I've said on Dunagan's show before that I well remember the issue of the Treasury 15 halves of 1998. I mean, can you imagine? I mean, basically, these bond yields are a reflection of the market's understanding of the risk, investment risk, when it comes to buying government debt. And that risk is increasing for the very simple reason that government finances are spinning out of control. They have debts which they cannot really finance, if you like, and yet they're borrowing more and more and more. Under those circumstances, there's only one way for bond yields to go, and that is up. And I can't even say that I can't even say that it'll stop at 15.5% this time, certainly in this country. I think the problem with America is you've got two elements of this. Firstly, the currency is the reserve currency, and it's very, very highly owned by foreigners and all the rest of it. That in the past has been very, very good for the dollar. But if the foreigners take fright and say, we're getting out of the dollar, then you're looking at ownership of the dollar, which exceeds US GDP by fully 1/3. And that is, that could be, a real problem. It's not just the foreigners also. I mean, domestic institutions are gradually waking up to risk. And when this credit bubble does pop, I'm sorry to go on about it, it is going to pop, then I think they're going to be looking at bond yields differently. And the interesting thing is that if you go back to 1929, 1932, the best performing stock of the lot was Homestake. What? Okay, I can see, basically there's very good reasons for that. Because, gold, if you like, is money. And as John Pierpont Morgan said, all else is credit. So if you've got someone who's actually digging money out of the ground at a time when the value of credit is collapsing, that's where you go. So I think that there are lessons in the past, which I think, we could actually spend a little time maybe researching in order to protect our wealth. And I think, incidentally, it's now a question of wealth protection rather than wealth accumulation. Got to be very, very careful.
In the face of that, we have a couple examples, rather high-profile examples, I might add, of the beginning. It's ironic. Rick, you often talk to us about you love to move into hated sectors where you see value, and then later on when everybody else comes along and endorses and adopts the point of view you had days or years or ahead of time, then you start to have to realize that, okay, this is becoming so widespread that I need to start tapering out. This is starting to happen. You've been the two of you and Andy Schechtman have been informing our viewers for years about the necessity of owning real things and not just derivatives, and being wary of the debts, deficits, negative real interest rates, and all of the factors that have combined and are continuing to combine, in some cases accelerate. We have an announcement from that came out just about a month ago that the asset management for the Harvard endowment is now putting a portion, approximately 7% of the Harvard endowment, into gold, for example. And we also have an announcement from just last week from Morgan Stanley's chief investment officer, Mike Wilson, saying that now instead of a 60-40 portfolio, 60% stocks and 40% bonds that they have recommended in the past, they're saying that a 60-20-20 portfolio strategy, 20% gold, is a more resilient inflation hedge than a 60-40 portfolio, and says 60% equities for long-term capital appreciation, but 20% gold and silver, substantial dedicated allocation to non-correlated hard asset. Rick, you said we should get to the bright point up here, and in the past you've said that sometimes it doesn't take a lot of a hedge to be an effective hedge if you pick the right one. So I'll let you take a first crack at that. These signs from officialdom that are finally people coming around to adopt what you've been recommending for some time.
Well, I guess I'm delighted, given that I'm positioned. I just think it's self-defense for the institutions. If you believe, as I believe, that in this sense past its prologue, that the US dollar will lose 75% of its purchasing power over the next 10 years, like it did in the decade of the 1970s, and I believe that, I think it's reasonable to suppose that the nominal price of gold, when I say nominal, I mean US dollar price of gold, will increase in a way that mirrors that. In the decade of the 70s, the last time the US dollar lost 75% of its purchasing power, the gold price ran 30-fold. Now, I'm not suggesting that over the next 10 years, the price of gold runs 30-fold, because as an example, since the year 2000, it's already risen 13-fold. But I am suggesting that the increase of the gold price, the nominal gold price, may likely mirror the decline in purchasing power of the US dollar. If that's true, the nominal gold price would increase 3 or 4-fold in the ensuing 10 years. If that happens, a reasonable allocation to gold can hedge a lot of the portfolio deterioration that you would experience in other parts of the portfolio. I want to say, too, that this isn't the only way up the mountain. I personally save in gold, but I maintain liquidity in US dollars. There's a very, very, very big difference between saving and maintaining liquidity. I don't own gold because I think it might go up. I own gold because there's been a golden constant. If you save in gold, if you look at home prices, or if you look at grocery prices, or you look at anything in your budget, save tax, you're surprised at how cheap things are measured in gold in the period 2000 to 2025. I think, too, that it's possible to over-allocate to gold. I know that'll be travesty in this call, but I note in the decade of the 70s, in the middle of an equities bear market from 1968 to 1982, a 14-year-long bear market that both Alasdair and I were part of, the Warren Buffett, who believed that gold was a pet rock, generated 24 or 25% compound internal rates of return over time. I would suggest to you that gold is merely a component, albeit a major component, of the strategy that will get you through the next 10 years. Alasdair mentioned earlier that on a global basis, allocation to gold relative to other savings and investment asset classes, according to JP Morgan Chase, is about 0.5%, despite the blandishments of the Harvard endowment. The 4-decade mean market share is 2%. If ownership reverted to mean, at least in the U.S. market, that would result in a 4-fold increase in demand for precious metals and precious metals related securities. I'm not smart enough to tell you what that would do to the price. but I think it would be interesting. Again, I had a phone call with a former client a couple days ago who is now 100% in gold. This is daft. This is truly daft. But 0.5% is daft too.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for September 29th through October 6th, 2025, while supplies last. First this week, 1 ounce gold Philharmonics are just $75 over spot. Next, 90% silver US half dollars are just 69 cents over spot per ounce. And finally, the silver Australian Year of the Snake coin for 2025 is just $5.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.